Welcome to the Deep Dive, the show that takes a dense stack of sources, articles, research papers, historical accounts, and, well, we pull out the essential knowledge you need to be truly well-informed.
And today, we are wading into the deep end of a topic that is universal, mandatory, and, let's face it, perpetually controversial.
Taxation.
Exactly. It's really the financial skeleton key of any organized society.
Mm.
I mean, if you want to understand how a civilization functions or even why it collapses, you just have to look at its tax system.
So our mission today is to move past the simple definitions you hear on the news. We're going to synthesize the core economic and political theories
And give you, the learner, a clear, nuanced view of the global system from, say, ancient tithes all the way to modern debates over optimal tax rates.
Okay, let's dive right into that central tension immediately, because that philosophical split really dictates every single argument we hear about tax policy today.
It does.
Our sources, they highlight two violently opposed viewpoints. On one side, taxation is just necessary. It's the engine oil of civilization, right? It funds the public goods that let us live in a secure, functioning, and, you could argue, an equitable society.
And then on the complete other side,
Mm-hmm.
you have this fierce denouncement. You hear this particularly from strong free market libertarian perspectives that classify taxation, I mean all of it, as nothing more than legalized theft
Theft or extortion.
or extortion
Yeah.
or a violation of fundamental property rights that's only enforced through the state's monopoly on coercion. And that tension, the need for collective funding versus the defense of individual property, that is the foundational conflict that underlies, well, all of modern governance.
It absolutely is, and it sets the stage for a great deep dive. So before we get into the big philosophical battles, let's ground ourselves. We need to start with the absolute foundation, defining what a tax actually is.
Right.
Because legally and economically, those definitions diverge in some really crucial ways that impact how policy gets designed.
Okay, so legally, the definition is, well, it's pretty broad and functional. It's a mandatory financial charge or a levy that's imposed by a government to support its spending.
So it's compulsory.
It's compulsory, and it can also be used as a regulatory tool, maybe to address negative externalities like pollution or something like that.
But economists, they're always seeking that analytical purity. They strip away anything that even looks like a commercial exchange. So what kind of government revenue in the eyes of an economist is not a tax?
Yeah, that's a great question. They exclude any transfer that looks like a price or a fee. So think of public university tuition, for instance,
Okay.
or the fees you pay for municipal water or electricity services. Those are quid pro quo payments. You pay for a very specific benefit.
I see.
They also exclude other non-tax revenue sources, like fines. A fine is a penalty, it's not a tax. Or voluntary gifts to the government. Or money acquired through borrowing.
Or just printing more money.
Exactly. Or even the mechanical processes of printing money or minting coins.
That is a vital distinction for you to grasp. So if I get hit with a hefty fine for, say, a building code violation, that is a penal transfer.
Right, it's punitive.
But my payroll withholding is a non-penal compulsory transfer.
Precisely. The litmus test for a true tax, economically speaking, is that it's a non-penal compulsory transfer levied on some predetermined criteria, like your income level or your property value, and critically, without reference to specific benefits received.
Right.
You pay your income tax, but you can't turn around and claim, that specific road repair or that soldier's salary was paid for by my $1,000. It's just funding the collective good in general.
And understanding that takes us straight to the dual purposes of levying taxes. The primary purpose is, well, it's obvious, filling the coffers. But the secondary purposes are where you see the true power of this mandatory charge.
The primary purpose is definitely revenue mobilization. It's about funding the essential public goods and services that the free market either wouldn't or, frankly, couldn't provide effectively.
And our sources list some comprehensive examples, things we rely on every single day.
Oh, absolutely. Massive economic infrastructure like roads, reliable sanitation, utility grids. Then you have the legal and justice systems, national defense, public security, public education, health systems, and crucial scientific R&D.
And debt.
And let's not forget servicing past government debt. A non-trivial portion of current taxes often goes toward paying interest on money the government borrowed years ago.
Right. But governments aren't just massive collection plates. They use taxation as a really powerful policy tool that reaches far beyond simple revenue collection. It's an active force in society.
This is what we call the beyond revenue aspect, or sometimes social engineering. Taxes are used to alter the relative prices of goods and services to affect demand.
So discouraging bad behavior.
Exactly. The goal might be to discourage consumption of something harmful, tobacco, alcohol, you name it. Or, on the flip side, to regulate cost or benefit, like providing a tax credit for installing solar panels. It's all about manipulating economic signals to align private behavior with public goals.
You also mentioned a fascinating and sort of more radical view on the purpose of taxes, the Chartalist view. Now, this is particularly relevant in economies with fiat currency. I mean, if the government can just print money, why tax at all?
Right. That's the central question chartalism tackles. Under that theory, taxes are not primarily necessary for funding government spending, because a currency-issuing sovereign state can literally create the currency it needs.
Okay, so then what's the point?
Instead, the purpose of taxation shifts dramatically.
Okay.
It becomes the mechanism by which the government creates demand for its own currency.
Walk us through that mechanism. How does a tax liability make me want to use the dollar or the pound?
Okay, so the government declares that taxes, that mandatory charge we talked about, must be paid in the government's own unit of account, its fiat currency.
I see.
By creating this compulsory financial liability that can only be extinguished with that specific currency, the state guarantees that citizens must earn, hold, and transact in that currency just to meet their legal obligation.
So it forces adoption.
It creates currency stability and gives the currency its fundamental value, even if the government were to spend nothing. And on top of that, chartalists argue taxes are essential to manage inflation by taking currency out of circulation, and they act as an economic lever to, guide the distribution of wealth or subsidize certain groups.
That just reframes the entire concept from a logistical funding tool to a fundamental pillar of monetary policy. Wow. Now, none of this intricate machinery works without actual compliance. Let's talk about the mechanics of making people pay up. It must be a massive logistical challenge globally.
It is. Tax compliance is the whole world of effort, policy, and individual behavior that goes into making sure taxpayers pay the correct amount on time while also getting the correct reliefs and allowances they're entitled to. It is an industry unto itself.
And it requires these specialized, powerful agencies. We all know them.
We instantly recognize these major global players, the Internal Revenue Service, the IRS in the U.S.,
His Majesty's Revenue and Customs, HMRC, in the UK.
the Canada Revenue Agency, CRA, the Australian Taxation Office, ATO. I mean, these agencies enforce the rules, but the complexity of the global economy means their job is never, ever simple.
And that complexity is the friction point. Non-compliance, whether it's intentional evasion or just unintentional avoidance, leads to immediate state intervention.
Absolutely. If taxes are not fully paid, the state imposes civil penalties, which generally means fines, interest on what you owe, or forfeiture of assets.
And if it's really bad.
In cases of intentional fraud or large-scale evasion, the state moves toward criminal penalties, which can and do result in incarceration. The mandatory nature of the charge is backed by the full coercive power of the state.
So if that chartalist view is correct, the compulsion to pay tax isn't just about funding, it's about validating the currency itself, and the compliance system is what ensures that compulsion holds.
Precisely.
Okay, we've established why we tax and what makes a tax mandatory. Now let's look at the sheer variety of what is taxed. If you try to compare the US, French, and Japanese tax systems, you'll just get lost in the weeds.
It's a mess.
So to help us navigate, we're going to use the Organization for Economic Cooperation and Development, the OECD's classification system. It should guide us through the major tax families.
The OECD system really does provide some order to the global tax landscape. So we'll begin with Category A, taxes on income, profits, and capital. This is really the cornerstone of most developed economies, and it starts, of course, with income tax.
Income tax is levied on net profits, gains, and other income of both individuals and businesses. But what makes its calculation so incredibly complex?
Well, it's complex because income itself is not a simple concept. It's calculated based on detailed accounting principles, which are then substantially modified by tax laws.
So you have to figure out the tax base.
You have to determine the tax base, what counts as income, what expenses are deductible, what allowances are granted. For an individual, this means managing everything from your wages and investment returns to the tax treatment of, say, medical expenses or charitable donations. And this leads to the fundamental variety in incidence.
And incidence, how the rate applies, is key to the whole political debate. We always hear about progressive, regressive, and flat systems.
A progressive system is one where the effective tax rate goes up as the amount of income goes up. This is typically done through graduated tax brackets, reflecting the idea of ability to pay.
And a flat tax.
A flat tax is just a constant rate that's applied to all income above a certain basic exemption threshold. And a regressive tax is one where the effective rate actually decreases as income increases.
But few countries have officially regressive rates, right?
Almost none. But deductions and loopholes can often render an otherwise progressive system, much less so in practice.
And the practical mechanics of collection for most working people rely on pay as you earn or payee.
That's right. Most personal income tax is withheld from wages throughout the year. This ensures a continuous cash flow for the government, and it reduces the financial shock for the taxpayer at the end of the year.
When the final bill comes due.
Exactly. At year end, the final tax liability is calculated. If you underpaid, you make a final payment. If you overpaid, you get a tax refund. Our sources really highlight the complexity around all the deductions and allowances, things like standard deductions versus itemized deductions, which fundamentally determine how much of your income is actually subject to tax.
Okay, let's move on to the cousin of income tax. The tax on wealth creation or capital gains. This is a constant source of political fights.
It is. Capital gain is the profit you realize from selling a capital asset, so something not held for sale in the ordinary course of business, like stocks, bonds, or real estate. The widespread controversy comes from the fact that many jurisdictions grant preferential lower rates for capital gains compared to ordinary income.
Why do they do that? I mean, why tax money made from labor wages at a higher rate than money made from an investment?
Well, the policy rationale is often centered on economic stimulation. Lower capital gains taxes are intended to incentivize investment, risk-taking, and capital formation.
The idea being that people will invest more.
The argument is that if investors know they can keep more of the profits when they sell assets, they are more likely to put money into the economy in the first place. The critique, of course, is that this disproportionately favors the wealthy, whose income is heavily weighted toward capital, and that leads to endless disputes over how you properly define capital to prevent tax avoidance.
Let's touch briefly on a theoretical but highly progressive structure, the negative income tax, or NIT.
The NIT is a mechanism that essentially flips the system for the very poor. So instead of simply having a zero tax liability, when your earnings fall below a certain poverty threshold, the individual actually receives a supplemental payment from the government.
It's like a refund you didn't pay in for.
You could think of it that way. It's a mechanism proposed to simplify welfare systems and ensure a basic income floor while still encouraging work, since the NIT benefit decreases slowly as your earned income rises.
That is a pure redistribution tool. Now, let's leave general income and look at mandatory contributions for specific social systems.
Okay, this is Section B, payroll and Social Security contributions. These are compulsory payments required from employers, employees, or both, based on wages or self-employment earnings, and they are specifically earmarked to fund things like public retirement, disability, or healthcare systems.
These contributions, though, they often feel less like a tax and more like a kind of forced savings, which is a key part of the debate around them.
That's the crux of the philosophical debate right there. Are they true taxes or forced savings? The argument for them being true taxes is pretty strong because of the inherent redistribution involved.
How so?
Well, funds collected from current workers are used to pay current retirees. That's an intergenerational transfer. And higher earners often contribute way above the level they could ever expect to recover in benefits, an intergenerational transfer. Because the benefits aren't strictly proportional to your contributions, economists classify them as taxes.
And what about payroll taxes that are distinct from Social Security contributions?
Payroll taxes are those imposed directly on the employer based on their total payroll. They're often used to fund things like unemployment insurance or vocational training programs. And crucially, even though the legal burden is on the employer.
The economic incidence might fall on the employee.
Exactly. It could fall on the employee through lower wages or just reduced hiring, which takes us right back to that concept of elasticity.
Speaking of fixed factors, let's move to Category C, property and wealth taxes. These are taxes levied on ownership, and they are, by their nature, very stable revenue sources.
They are. Recurrent property taxes are ad valorem taxes, meaning they're assessed based on the value of the property immovable, so real estate, and sometimes movable, like personal property. And they're stable because property values generally don't fluctuate wildly year to year like, say, corporate profits or sales do.
And property taxes have inspired some of the most creative forms of tax avoidance in history. The 17th century English window tax is the classic example.
Oh, it is brilliant, and it's so visually illustrative. It was levied in 1695, and it charged property owners based on the number of windows they had.
And the result?
The result, property owners, to minimize their tax bill, just bricked up their windows. It's that simple. You can still see this legacy in listed buildings all across Britain. The French had a hearth tax that had a similar effect. It just shows that people will rationally alter the appearance and function of their property purely to minimize a tax liability. It leaves a literal architectural footprint on history.
A highly specific type of property tax often championed by classical economists is the land value tax, or LVT. Why does it get so much support in those circles?
The LVT is levied only on the unimproved value of the land. So it specifically ignores the value of any improvements, the house, the factory, the barn that are on the land. Proponents argue it's the most economically efficient tax because the supply of land is fixed, or what economists call perfectly inelastic.
Right, taxing it doesn't discourage the land from being there.
It's not going anywhere. And furthermore, taxing improvements is inherently punitive to productivity. You tax someone for building a better building. LDT avoids that disincentive entirely, and so it avoids what we call deadweight loss.
In addition to taxes based on continuous ownership, we have taxes based on the transfer of property.
Right, these are the event-driven property taxes.
Right.
The major ones are inheritance or estate taxes. In many systems, there's a distinction. An estate tax is levied on the total value of the deceased's assets before distribution.
Well, an inheritance tax is on the person receiving it.
Exactly. It's levied on the beneficiaries based on the value of the property they receive. These taxes are debated fiercely because they often represent a form of double taxation, taxing wealth that was already taxed as income during the owner's lifetime.
And transfer taxes, like stamp duty, how do they affect the broader economy?
Transfer taxes, which are charged when ownership changes hands, are often criticized because they discourage liquidity. For example, a high stamp duty on a property sale or a stock transfer means that even small, profitable transactions might not be worth doing after you factor in the tax. Our sources note this effect is often used by governments intentionally to discourage speculative asset purchases by raising the cost of rapid turnover.
Finally, in this category, let's look at the general net worth or wealth tax.
A wealth tax is levied annually on the total value of a taxpayer's personal assets. Real estate, bank deposits, securities, even art collections, minus their liabilities like mortgages. It's often highly complex to administer because all those assets have to be valued accurately every single year.
And it's prone to capital flight.
Very prone to capital flight. Wealthy individuals moving their easily movable assets, like stocks, to jurisdictions that don't levy the tax. Historically, many European countries that experimented with wealth taxes have since abandoned them, just due to low revenue yields and extremely high administrative costs.
That complexity takes us perfectly to the category most people interact with daily: taxes on goods and services, or consumption taxes. The global rivalry here seems to be between the value-added tax, VAT, and the sales tax. Let's start with VAT, or GST.
VAT is levied almost everywhere outside of the U.S. Its mechanism is a bit complex, but really powerful. It applies the tax at every single stage of the supply chain where value is added, but businesses only remit the tax on the value they contributed.
Okay, give us the mechanic again, that input tax, output tax dance.
Sure. A company purchases inputs, let's say raw materials, and it pays the input tax. When they sell the finished product for a higher price, they charge the output tax. They then remit to the government only the difference between the output tax they collected and the input tax they already paid.
And the difference is the tax on the value added.
Exactly. This continues all the way down the chain. And the brilliance of the VAT is that the final retail consumer, who can't claim back any tax, ultimately bears the entire accumulated tax amount.
So why do governments, particularly in Europe, prefer the VAT mechanism over a simple sales tax? It sounds so much more complicated.
It comes down to accountability and auditability. The VAT system is basically self-policing because every firm in the chain has a direct incentive to track and report the VAT it paid, the input tax, to reduce its own liability.
It creates a paper trail.
An incredible paper trail that's a huge deterrent to tax fraud, making collection much more robust. Plus, VAT systems often include zero rating for exports, meaning goods sold internationally leave the country without VAT embedded in the price, which makes their exports more competitive on the global market.
And that contrasts sharply with the simplicity and the political vulnerability of the sales tax.
A sales tax is levied only once, at the point of final sale to the consumer. And while it's simple to administer, It is often fundamentally regressive.
Because poorer people spend a higher percentage of their income.
A much higher proportion of their total income on consumable goods than wealthy individuals do.
Which is why we see the political necessity of exempting things like food.
Absolutely. Exempting basic necessities like unprepared food and utilities is a common policy tool that's used to increase the overall progressivity of a sales tax system, trying to mitigate that disproportionate burden on the poor. And it's also important to note that a few U.S. states rely very heavily on sales tax.
Right. Alaska and New Hampshire don't have a state income tax at all.
Exactly. This means their state revenue stability relies almost entirely on continuous consumer spending.
Okay, finally, we have taxes used specifically for behavioral modification, excise duties, and tariffs.
Excise duties are indirect taxes imposed on goods during production or distribution, usually proportionate to quantity or value. They were historically introduced in England on things like beer, ale, and tobacco. Today, they're best known as sin taxes.
Right, sin taxes are the primary policy tool to discourage consumption and sort of internalize societal costs.
Precisely. By taxing alcohol, tobacco, or sugary drinks, the government drives up the price, and ideally that reduces consumption. And crucially, these taxes are often combined with hypothecation, where the proceeds are earmarked.
So they're not just placed in the general fund.
Right. They're specifically designated to pay for costs associated with the taxed activity. For example, revenue from a carbon tax might be hypothecated directly toward developing renewable energy or funding preventative health campaigns related to smoking.
And tariffs, which specifically deal with political borders.
Tariffs or customs duties are just charges on the movement of goods across borders. And while they do raise revenue, their main policy function is often protective, to actively discourage imports to protect domestic industries. They're a classic barrier to trade.
And like excises, the revenue is often hypothecated.
Often. It's earmarked to pay for government functions that are closely tied to the borders, like maintaining a navy, border police, or customs enforcement itself. The entire system of international trade disputes often revolves around putting on or taking off specific tariffs.
It's so easy to look at our complex, 96,000 regulation systems and think this complexity is new, but mandatory levies are a fundamental technology of organized governance, stretching back thousands of years. Let's dive into some of the ancient systems.
Yeah, the need for mandatory transfers arose the moment centralized administration began. The first known system was in ancient Egypt, roughly 3000 to 2800 BC. But the key forms were surprisingly direct and, well, brutal. The corvée and the tithe.
And the sources note that in ancient Egypt, the word for labor was literally synonymous with taxes.
It was. The corvée was forced labor. Peasants who were too poor to pay in goods or currency were compelled to work on state projects building irrigation systems, temples, pyramids.
And the tithe.
The tithe, a mandatory agricultural contribution, was recorded during the pharaoh's biennial tour, where he would collect a portion of the harvest. This was basically an early form of agricultural income tax with meticulous records kept on things like limestone flakes. It was compulsory, non-penal if you paid it, and without specific benefit of tax by any modern definition.
The Persian Empire under Darius I, around 500 BC, seems to have taken this collection system to a new level of sophisticated economic planning.
Darius introduced a meticulously regulated and remarkably customized tax system for his vast empire. It was tailor-made for each province, or satrapy. And the assessment wasn't universal. It was based on the region's supposed productivity.
So different regions paid in different things.
Completely different. Babylon, being rich and productive, was assessed for the highest amount of silver plus the army's food supply. India, famous for its gold, paid in gold dust. Egypt, the granary of the empire, paid in huge measures of grain alongside silver talents.
That suggests a pretty sophisticated understanding of regional specialization and economic potential.
It really does. It wasn't just arbitrary. It recognized that wealth takes different forms. However, this system also created a massive opportunity for the satrap, the provincial governor, to potentially abuse the system. They collected the required amount, deducted their own administration costs, and sent the rest to the treasury. This structure, which delegated tax collection authority, really foreshadowed the problematic system of tax farming in Rome.
The Romans and their publicani. That just sounds like a disaster waiting to happen.
And it often was. In the early Roman Republic, they relied heavily on private tax farmers, the publicani, who would bid on the right to collect taxes in a given province. They paid the revenue to the government in advance.
So they were essentially loaning the state money.
Exactly. They provided a loan, And then they had a very strong incentive to extract as much as possible from the populace to cover their advance payment and, of course, generate a profit. This led to widespread corruption and exploitation.
And how did Emperor Augustus fix this when he transitioned the system?
Well, Augustus realized the inherent instability and corruption of tax farming. He replaced it with a direct system run by imperial administrators. This included a 1% wealth tax and a flat rate tax on every adult, which required regular census counts to maintain accurate records. That shift was key. It centralized control and moved the burden away from these rapacious private entities to a more organized, state-run bureaucracy.
History is just littered with these brilliant economic taxes that were total political failures. The poll tax is maybe the best example of a tax that is economically sound but politically explosive.
Oh, absolutely. The poll tax, or a capitation tax, is a fixed amount levied per individual, regardless of their income or their ability to pay. Economists love its efficiency because people are assumed to be in fixed supply. Since the tax is fixed, it doesn't change economic incentives, it doesn't distort how much you work or how much you spend, so it avoids deadweight loss.
But if it's so economically efficient, why is it such a political disaster everywhere it's been tried? I mean, isn't that political cost a form of deadweight loss itself in terms of societal upheaval?
That's the perfect question, and it just illustrates the conflict between pure theory and messy reality. Because the tax is fixed, it is fundamentally and crushingly regressive. A king's heir pays the same fixed amount as the poorest peasant.
And that drives people to revolt.
That massive, disproportionate burden is what drives civil unrest. In 1381, the introduction of the poll tax in medieval England was the direct, primary trigger for the bloody peasants' revolt. Fast forward to the late 1980s, the UK government's attempt to introduce the community charge, which was a form of poll tax to replace property-based local rates, led to massive non-payment campaigns and the infamous poll tax riots. It contributed significantly to the fall of Margaret Thatcher.
Wow. Political feasibility trumps economic purity every single time.
Every time.
Just for fun, let's briefly mention some of the strangest forms of tax governments have come up with. Scutage, tallage, and the czar's beard tax.
These just show the endless creativity of the state. Scutage was simply a payment you made to a lord instead of performing your mandatory military service. Tallage was levied arbitrarily on feudal dependents. And the famous czarist beard tax, introduced by Peter the Great, was an attempt to modernize Russia by taxing an old custom. If you pay the tax, you got a little copper token to prove you were compliant and could keep your beard.
It's a literal illustration that if a government can control it, they will absolutely tax it.
You bet.
So, synthesizing this history with modern trends, what does the last few centuries tell us about the size of the state?
The size of the state, when measured by tax revenue, increased dramatically in Europe throughout the 18th and early 19th centuries. And the primary driver wasn't necessarily greater public service, but continuous costly warfare and the corresponding need for more centralized, effective administration. Our sources cite a study showing Britain's tax burden increased by 85% during this period. However, because the economy was growing steadily, the real per capita burden only doubled before the Industrial Revolution really exploded. France, despite having lower tax rates, had a more oppressive system, with taxes levied heavily on landowners and on internal trade, which generated massive resentment that helps lead to its revolution.
That's critical. It's not just how much is collected, but how it's collected and from whom. Let's use the modern yardstick. Tax to GDP ratios from around 2016.
These ratios measure the total tax take as a percentage of the gross domestic product, and they show you the size of the public sector relative to the total economy. The differences are staggering. Denmark and France hover around 45% and 45.3% respectively, which reflects these comprehensive social democratic systems funded through high taxation.
And the U.S.?
The U.S. sits significantly lower at 26.0%. And globally, higher income levels tend to be associated with higher tax to GDP ratios, demonstrating that as nations develop and their institutional capacity improves, the state is able to mobilize a greater share of the national income.
And finally, let's talk about the immense hidden cost of the system, the sheer complexity. That 6.5 billion hours figure for U.S. compliance is almost unbelievable.
It truly is. The complexity is just staggering. Germany's tax system is legendary for it, involving 118 laws and 96,000 separate regulations. But let's really internalize that U.S. figure. Americans spend 6.5 billion hours annually preparing their taxes.
That's the labor equivalent of?
It's the labor equivalent of 741,501 people working full-time, 24 hours a day, for an entire year just on compliance. That figure represents productivity that is just lost to the economy. It's a massive, unacknowledged burden that is entirely unproductive. It's money and time spent purely on interpreting and satisfying the rules, not on generating any actual wealth.
That staggering cost of complexity brings us right into the core economic analysis of taxation. We have to address the question of who actually pays the tax, which is the crucial concept of tax incidence.
Tax incidence is the ultimate economic burden of the tax, and it is almost always different from the party that is legally levied. The law dictates who writes the check, say the business owner or the importer. But the free market, through supply and demand, dictates who ultimately suffers the reduction in income or the increase in price.
So if the government imposes a new tax on coffee producers, it doesn't mean the coffee producers actually pay it. They might just pass the cost on to me, the consumer.
Exactly. The key rule of incidence is this. The greatest share of the tax burden falls on the most inelastic factor involved. Elasticity measures how much supply or demand changes in response to a price change. If demand is highly elastic, consumers will just stop buying when the price rises, which forces the seller to absorb the tax.
And if demand is inelastic?
If demand is inelastic, consumers keep buying regardless of the price, which allows the seller to push the tax onto the buyer.
Okay, let's illustrate with two contrasting examples. First, a highly elastic good, like a new luxury tax on high-end sports cars.
A high-end sports car has highly elastic demand. If the government adds a, say, $50,000 tax, the buyer has tons of alternatives, a less expensive luxury car, a bigger SUV, or just investing the money. If the manufacturer tries to raise the price by the full $50,000, demand collapses.
So they have to eat the cost.
The car manufacturer, unable to lose all those sales, has to absorb most of the tax burden by reducing their pre-tax price significantly, thereby reducing their own profit margins. The incidence falls heavily on the producer.
Now contrast that with an inelastic factor, say a tax on essential prescription medication where no substitutes exist.
Essential medicine has highly inelastic demand. People need it regardless of the price. If a tax is imposed, the producers can pass the vast majority of that tax directly onto the consumer in the form of a higher price, because demand won't significantly decrease. The consumer, whose demand is inelastic, bears the heaviest burden of the tax incidence. This is why economists stress that policymakers have to look beyond the legal definition of who pays to see the true economic effect.
All right, now let's turn to the potential benefits. When does taxation actually increase overall economic welfare? This sounds like a contradiction.
It happens when we address market failures, specifically negative externalities. These are costs that are imposed on society but are not paid for by the consumer or the producer. Pollution, traffic congestion, or public health costs associated with harmful consumption. These are classic examples.
And this is the realm of the Pigovian tax.
Exactly. Named after the economist Arthur Pigou. A Pigovian tax is designed to internalize those external costs. By taxing the source of societal harm, say a carbon tax on emissions or a high sugar tax on soda, the government forces the free market to incorporate the full societal cost into the final price.
So it corrects the market?
It corrects the market failure, it leads to fewer socially harmful transactions, and it simultaneously raises revenue. It actually increases overall economic efficiency because resources are being allocated based on their true costs.
Beyond Pigovian taxes, progressive taxation is also seen as a mechanism for enhancing collective welfare.
Generally, yes. Progressive taxation, by taking a higher percentage from higher incomes, generally reduces economic inequality, which can lead to higher collective welfare even if the revenue isn't immediately redistributed. It narrows the income gap, which many social welfare models view as inherently beneficial for social stability.
Okay, now for the primary way, taxes reduce economic welfare, deadweight costs.
Deadweight loss is the unavoidable cost to society created by a tax. It arises because a tax creates a wedge between the price the buyer pays and the price the seller receives. And this wedge causes a reduction in the number of transactions that occur.
Okay, explain that lost transaction.
Sure. Imagine a buyer is willing to pay $10 for a good, and the seller is willing to accept $9. In a free market, a trade happens. Both parties benefit. Now, if a $2 tax is imposed, the buyer would have to pay $11, and the seller would only receive $9. The tax has made the transaction unprofitable for the seller because they only receive $8 after the tax, which is less than their $9 minimum.
So the deal doesn't happen.
The deal doesn't happen. That transaction, which would have benefited society, is lost. That lost benefit to both parties, which no one collects. That is the deadweight loss. It's pure economic inefficiency.
So the key to good tax policy is minimizing that deadweight loss.
Absolutely. And the way to minimize it is to use non-distortionary taxes, taxes that don't change economic incentives and thus avoid creating that wedge. And we identified two types earlier.
The land value tax and the poll tax.
Correct. The LVT is non-distortionary because the supply of land is inelastic. Taxing it doesn't stop land from existing or change the incentive to use it efficiently. The poll tax is non-distortionary because, being a fixed fee, it doesn't change your marginal economic choices about working or spending.
But
The challenge, as history proves, is that while economists love these pure non-distortionary taxes for their efficiency, politicians fear them for their extreme regressivity and their political toxicity.
we also have the hidden cost of perverse incentives caused by complexity. This is the other major way taxes reduce welfare.
The immense complexity in systems like in the US or Germany creates vast opportunities for legal tax avoidance, finding loopholes to minimize your liability in illegal tax evasion. This results in lost revenue, but it also creates the additional deadweight cost of paying for expert tax advice.
All those hours.
All those hours Americans spend on preparation, and all the money spent on accountants and tax lawyers, it adds no wealth to the economy. It is a cost created purely by the complexity of the rules. Simple, transparent structures, like a well-designed VAT, are often recommended precisely to reduce these loopholes and perverse incentives.
Our sources take us now to a critical area, the challenges of taxation in developing countries where the political and economic landscape is just fundamentally different from the OECD nations we've been discussing.
Yeah, and domestic revenue mobilization is arguably the most crucial pillar of state building in these countries. It's more stable, more predictable, and it fosters greater accountability than relying on, say, overseas development assistance, ODA, or foreign aid, which can be volatile and subject to the donor's political goals.
But the core challenge is that low tax-to-GDP ratio. It's averaging around 14% in low-income countries compared to over 34% in OECD countries. What are the key hurdles they face in trying to close that gap?
There are several major hurdles. First, the large informal sector, which averages around 30% of the economy. These economic activities, street vendors, subsistence farming, cash-based services, are incredibly difficult and costly to tax efficiently.
And
Secondly, there's high revenue volatility, particularly in resource-rich countries that depend heavily on oil or minerals, whose prices just fluctuate wildly on the global market.
And the third major challenge involves multinational corporations, which are the easiest targets but also the most complex.
Yes, the dependence on a narrow tax base often means a heavy reliance on multinational corporations, or MNCs. However, these MNCs have sophisticated tax departments that exploit limited regulatory capacity through transfer pricing abuse.
Okay, explain transfer pricing for the learner.
Transfer pricing is the process by which different branches of the same multinational company, say, a manufacturing plant in country A and a distribution center in country B, charge each other for goods or services. Now, if the tax rate in country A is 30% and in country B is 5%, the MNC has a massive incentive to structure the internal prices so that all the profits are recorded in country B, the low-tax jurisdiction.
And the high-tax country sees almost no profit at all.
Exactly. Developing countries often lack the specialized expertise to audit these complex international transactions, which allows vast amounts of potential tax revenue to just leak out.
I've heard that these nations often try to attract investment by offering tax incentives, like temporary tax holidays. Do these even work?
The evidence suggests they are marginally influential at best. Investors are far more swayed by economic fundamentals. Market size, infrastructure quality, ports, roads, power, and the local skill base. Offering a tax break to an investor won't matter if the road to their factory washes out every rainy season.
And they can backfire.
And they often erode the already narrow tax base and introduce more complexity, which can just exacerbate corruption.
And what about the administrative side, the cost of compliance in these regions?
Compliance costs are astronomically high. Processes are lengthy, tax payments are frequent, and the bureaucracy often breeds corruption and requests for bribes. Even simple tasks like getting a tax refund can take months. Fragile or post-conflict states struggle the most, though surprisingly, tax revenue can surge during rebuilding efforts, as we saw in Liberia and Mozambique post-conflict, where the shared mission of rebuilding can sometimes generate a temporary compliance momentum.
Okay, let's pivot back to the philosophical side. We started with the core tension necessity versus freedom, but let's explore the moral justifications for and against taxation.
On the side of support, the most succinct justification comes from Justice Oliver Wendell Holmes, Jr. Taxes are the price of civilization. This view asserts that collective living necessitates collective funding for mutual benefits, like legal security and defense. And supporters argue that if the tax is progressive, it reduces inequality and promotes social stability, which benefits everyone in the long run.
And the conservative argument isn't just about revenue, it's about political accountability.
That's a key distinction. The conservative principle often insists that everyone should pay for government, even if it's only a minimal amount, lest citizens come to believe that government services are costless to them.
Because if services are perceived as free,
People will naturally demand more, leading to bloated, inefficient state spending. Social Democrats, conversely, see higher taxation as the necessary means to fund universal public services, health, education, as central to a mixed, equitable economy.
okay, now let's face the strongest opposition, the classification of tax as theft or extortion.
This stance, primarily held by libertarians and anarcho-capitalists, centers on the non-aggression principle. They argue that property you've earned is ethically held, and any compulsory taking of that property, even if it's voted on by a majority, is still aggression. The compulsory nature of the payment, enforced by the threat of imprisonment or asset forfeiture, is what validates the extortion label in their view.
And a major practical argument against tax is the perception of government waste.
Right. Critics argue that immense public inefficiency just invalidates the state's claim to the money. Why hand over hard-earned money if it's just going to be squandered? They point to things like President George W. Bush proposing to eliminate 151 discretionary programs in one budget due to redundancy or ineffectiveness. And when you couple that with the massive deadweight loss from compliance hours, they argue the government is an inherently poor custodian of public resources.
We must also address the specialized viewpoint of Geoism or Georgism and the concept of the single tax.
Geoism, which is rooted in the work of Henry George, argues for a deeply moral distinction between earned income from labor or production and economic rent. Economic rent is the value derived from factors that were not created by the individual, specifically the value of land and natural resources.
And Geoists argue that this value naturally belongs to the community.
Exactly. So they advocate for the land value tax, the LVT, as the single tax, replacing all other levies.
Then why do they consider the LVT moral?
Because LVT taxes only unearned value. It doesn't punish productivity or require the state to monitor private transactions like income or sales. It is considered both morally justified and highly efficient, as we discussed, because of the inelastic supply of land, which avoids all forms of deadweight loss and perverse incentives.
Finally, the theory of tax choice attempts to bridge that gap between necessary revenue and individual liberty.
Tax choice suggests that taxpayers should retain a significant degree of control over the allocation of their individual taxes, allowing them to choose the percentage split, say, between defense, education, or healthcare. Supporters argue this increases government accountability, forcing agencies to be more efficient and responsive if they want to secure funding from the pool of designated taxes. It's an attempt to replicate the signaling mechanisms of the free market within the public sector.
We're going to conclude our deep dive by moving from philosophical concepts to the hard mathematical theories that policymakers try to grapple with, the relationship between tax rates and total revenue. And this starts with the legendary and perpetually controversial Laffer curve.
The Laffer curve is a theoretical representation plotting the relationship between tax rates from 0% all the way to 100% and the resulting government tax revenue. It's based on a pretty simple logical thought experiment.
Okay, we know revenue is zero at a 0% tax rate. But let's clarify again. Why is revenue also theoretically zero at a 100% tax rate?
Well, at 100%, there's zero financial incentive for a rational person to work or invest legally because every single dollar you earn is immediately confiscated by the state. So economic activity that generates taxable income just grinds to a halt, and revenue becomes 100% of zero.
And since revenue is zero at both extremes,
the curve logically dictates that there must be an intermediate optimal rate where tax revenue is maximized. This is the revenue maximizing rate.
the implication, which is often weaponized politically, is that increasing tax rates past this optimal point becomes counterproductive, potentially even leading to lower revenue.
That's the core thesis. But the massive policy dispute isn't about if the curve exists, it's about where we are currently positioned on it. And this leads to the whole debate between static and dynamic scoring.
What's the difference between static and dynamic scoring?
Static scoring assumes that a change in the tax rate, say a tax cut, will have no effect on people's behavior or the overall size of the economy. It just multiplies the new lower rate by the old economic base.
But that's not how people work.
Not at all. Dynamic scoring, in contrast, attempts to account for behavioral changes. It assumes a tax cut will incentivize more work and investment, expanding the tax base and potentially leading to a smaller loss in revenue or even a net increase if the economy is currently on the right side of the Laffer curve peak. Policymakers rarely agree on the elasticity of labor and capital, which makes the curve's application highly subjective, though mid-range estimates for the revenue-maximizing tax rate often settle around 70%.
The Laffer curve is focused purely on maximizing revenue. Optimal tax theory, however, aims for something much broader, maximizing social welfare.
Right. Optimal tax theory considers how taxes should be structured to achieve specific societal goals, whether that's minimizing economic distortion or maximizing social equality. The Ramsey problem, a key element of the theory, focuses specifically on minimizing those deadweight costs.
So if the goal is purely to minimize deadweight loss, what does the theory suggest we tax the heaviest?
It suggests putting the highest tax rates on goods, services, or factors of production, for which supply and demand are the most inelastic. The logic is simple. If demand doesn't change when the price rises because of the tax, then fewer transactions are canceled and less deadweight loss is incurred.
Which brings us back to the land value tax again.
This mathematically supports, once again, the LVT, or taxes on essential inelastic goods, though of course that raises huge concerns about equity.
And if optimal tax theory integrates social welfare, that idea of diminishing returns?
If we accept the idea of diminishing returns from income, that the last dollar earned is less valuable to a billionaire than the first dollar earned is to a minimum wage worker, then the theory overwhelmingly supports a progressive income tax structure. This structure maximizes social welfare by moving revenue from where it provides the least utility, the wealthy, to where it can provide the most, which is collective public goods and transfer payments to the poor.
Okay, let's try to synthesize this massive deep dive. We started with the simple definition of a mandatory charge. We charted its history from ancient corvée labor, navigated the typology tangle of income versus consumption, and finally landed on the economic cost of deadweight loss.
I think the key takeaway for you, the learner, is that the choice of tax system is fundamentally a choice about economic values. Are we prioritizing efficiency, minimizing deadweight loss, which often favors consumption or property taxes? Or are we prioritizing equity and ability to pay, which favors progressive income taxes? The political and economic reality is that the actual incidence of the burden often falls in unexpected places, dictated by market elasticity rather than legislative intent.
And at the end of the day, the complex system is a continuous, agonizing balancing act between necessity funding the roads, the hospitals, the schools we rely on, and efficiency protecting the individual incentives that drive productivity and wealth generation.
Which leaves us with that central policy challenge, stemming directly from the Laffer curve and the necessity of revenue. Given the political reality, where citizens globally, including a significant majority in the U.S., feel their tax burden is too high, where should society strive to place that tax rate? The ongoing critical debate is how to find that sweet spot, the rate and structure that maximizes necessary revenue and collective welfare, while simultaneously minimizing the political, compliance, and economic deadweight costs.
That balancing act, the constant negotiation between private freedom and public good, is the enduring mission of every government and every taxpayer. We hope this deep dive into the source material has given you a clearer lens through which to view those complicated choices.
Indeed. Consider the implications next time you see a proposal for a new excise tax, and ask yourself, is this Pigovian efficiency, or is it just another regressive burden?
Thank you for joining us for the deep dive.
Until next time.